Hey traders, Okana here. I'm going to show you a strategy and a tool. Basically, it's a oscillator. It's called the Ultimate Oscillator. You can read more about it here, and I will put the link and the download link to the indicator as well in the description, so you can check it out and read the article about how it works. And I'm going to show you the indicator here. I've downloaded it, inserted the indicator, 3 levels. You have the 70 overbought, the 50, the mid level, the signal level, and the 30 level oversold. Okay, just like the regular oscillator with the overbought, oversold, but different levels. So what you want to do is to look for a trending area first. For example, in this case you see price is trending up, and then you're going to look for an overbought position when price is trending up. So in this case you see it's overbought here, but we don't get a signal because the candle does not cross the 50 and you don't see any divergence. Price is still continuing up, so nothing to do here. And the next position where the oscillator goes above the overbought level is here, and then price is coming down. So here you must also use some price action, because this is good for experienced traders. If you're not, you shouldn't use this. So you should already know these things about placing lines. For example, here you see we had a higher low, the breakout here. You can see the candles, so an experienced traders will see this, the breakout, and then price got support, came up, and then it failed. And now if you look at this area on this candlestick, this red candlestick, remove the line so you can see it. So on this candlestick, when this one closed below the support line, you could also see that the oscillator moved below the 50, and that's our signal here. And you must have a target. So as a price action trader, you would look to the previous history. You would see this was a strong resistance, so this is our target. Now remember, we don't know anything about what's happening on the right. We just know we have a potential target here. Price broke the support line, and we got the signal from the oscillator that it crossed the 50, and it was very overbought up here. So it's moving down, and then you calculate based on the expiry of the previous movements, like how many candles you need. I usually use a little bit a lower number of candles when I calculate based on history, because for example in this case the price is still in an uptrend, so you're doing a reversal here. It's a little bit dangerous. You don't want to give it too long time because the trend might continue later on. You don't know that. So in this case we had 1, 2, 3, 4, 5, 6, 7, 8, 9, around 8 hours before this target was reached. So now it's falling. I would say maybe a few hours less than the time that it took for it to come up, because remember the bulls were in charge. That's how it works. That's for the put signal. And there is another thing you should also check out for, because in the article it says you have to look for a divergence in the trend. So what I'm using is also a 200 EMA. I'm going to show you how. So for example, in this case you see that the price is above the 200 EMA, so it's bullish, right? But if you go to a daily chart, you would see that actually price is below. In this area it was below the 200, so it just touched the 200. If we remove our line, you can see that just happened to touch the EMA 200. So you were expecting strong resistance. So if you go back to our chart, back to our hourly chart, you can see that this area was in fact a strong resistance, and you couldn't have known that if you didn't do those price action analysis. You didn't check the EMAs, you didn't check where the strong support resistance was. So now we know that this area was strong, and as you can see it later became support before price started falling. So keep those things in mind. If you don't, then this is going to be totally useless. You're going to get into a lot of fake trades. The opposite is true when you're in a downtrend. You're going to wait and spot an area of divergence, and you should take a look at areas where price is coming back up. For example, in this area here is a very good example because you have a drop on the bearish in the bearish movement. So you have a bearish movement, you see a divergence, price is well below the oversold area. It's starting to come back up. So here we're gonna wait and see if we're gonna get a signal. Now you don't want to jump in just because it crossed the 50 here. You can see it's already crossed the 50 on well, it was confirmed on this candle, but you don't want to jump in there because, as you can see if you look back, it was support here. The support is now resistant, it's not broken yet, and we have our trend line here. So a more correct entry would have been on this candle when it actually broke and held. So preferably either after this candle or in the beginning of this candle, you could have entered here for a call option, because this is the divergence. You see price is no longer making lower highs and it's not overbought. You could also use the regular stochastic together with this ultimate oscillator or an RSI, but you would see that price is not moving down again, but rather broke the trend line, broke the resistance line. So that's a good indication. Plus the oscillator was oversold and now is above the 50 line. So this is how you should use it, with price action in mind. Unless you have mastered the price action, don't use this indicator. So I hope you like this. Thanks for watching.